we have bad debt and provision for bad debt here to be adjusted, right? When the amount supposed to be recoverable from bad debtors becomes default, then how do I handle? Then it's called bad debt and it should be a loss and debited to the people. Okay. C. Rupees 10,000 is the debtors amount from whom I have to get 10,000 rupees, but out of which 200 rupees not recovered, becomes bad. Becomes bad. This is the first scenario. It means facing the bad debt loss without having any provision for that. Okay, that's a one type. In the second type, 10,000 rupees and we have bad debt rupees 200 in this year. Bad debt in this year, 200 rupees. But we have already created a provision for that. I use the shortcut or short name here, PDD, provision for doubtful debts, which is rupees 150. What does it mean? What does it mean? Is that okay? See, in general, what do? You actually celebrate Diwali once in every year, right? Diwali celebration. And for the Diwali celebration, you may spend around say 25,000 or 30,000 rupees as an additional to the regular expenses you do. What do? From your parents' paycheck, right? Assume that salary. From the salary, amount is transferred for the Diwali expenses, 25,000 rupees. Isn't it? So every year there is a huge expenses going to be spent during the Diwali time, as well as during the admission time of the students, right? Kids. Similarly, here also 25,000 rupees is going to be spent for the Diwali, that is transferred from the salary. If the salary being say around 40,000 rupees, usually during the month they usually spend around 25 to 30,000 rupees by default. Suddenly in Diwali time they don't have the surplus fund to manage this, right? Anyhow they have to manage, they have to celebrate. This is one way. Rather than this way, what they do? Salary and Diwali. Okay, Diwali is there. We predict that 25,000 rupees is in need for the Diwali celebration. So, releasing the 25,000 rupees from the salary exactly in that month is very expensive. What we can do? We can keep around some money away named as Diwali fund. Diwali fund. How much? Rather than depositing full amount, every month you may transfer 2,000 rupees. So in a year's time, the amount could have been accumulated in Diwali fund is how much? 24,000. What is the spending for the Diwali by the time? 25,000. So it's now safe without any financial trouble. You can spend this money. 24,000 rupees is now used from Diwali fund account, and shortage 1,000 rupees can be taken from salary. Okay, 24,000 from here and 1,000 is from here. Is that okay? Just think over, suppose if the spending rather than 25,000 rupees, if it is just 20,000 rupees surprisingly, we spend lesser. Practically it's not possible, but I assume so. We spend lesser. If we spend lesser, we'll use that 20,000 rupees from Diwali fund, and from salary account we don't use anything. That excess surplus amount available in Diwali fund will be transferable to your normal salary expenses. Like for salary account, you can spend that, right? 4,000 is transferred, excess. You now equate the salary account is equivalent to profit and loss account. Diwali spending is equated with the bad debt. Bad debt. Very simple, right? This is bad debt. This is nothing but P&L account. What about this one? Provision for doubtful debts. Very simple. Now you understood. Now, what is the journal entry for bad debt here? Bad debt is a loss. Similar to the depreciation. Depreciation is a loss. That depreciation will reduce the value of the asset. Similarly, this bad debt will reduce the balance of debtors amount, right? So the value being bad debt account debit, bad debt account debit to bad debt account debit to debtors. How much is that? 200. Now this bad debt will be adjusted somehow. No, where do you adjust that? By transferring to the P&L account. Diwali expenses is transferred to salary account. Similarly, here the bad debt account is transferred to P&L account. The entry being profit and loss account debit to bad debt. So this is a set of entry you have to keep in your mind. Okay, this is the set of entry you have to keep in your mind. Is that clear? This set of entry will be passed when we don't have the provision for doubtful debts. If we have the provision for doubtful debts, the pattern is different. The pattern is different. For the second one, bad debt with the provision for doubtful debts, how do I now handle this? How do I handle this? Very simple. Bad debt is a loss. What's the entry for that? Bad debt account debit. Bad debt account debit to debtors. How much is the loss? 200 rupees. You spend the money for Diwali, right? You spend that money. Diwali expenses to cash. Over. Similarly, here bad debt account debit to debtors. Now, what do you do with the bad debt? That bad debt should usually be adjusted in the P&L account. But anyhow, we have already kept aside some money in the name of PDD, so we can use this amount to be adjusted in the PDD account. So, right. Now, the entry being PDD account debit to bad debt. How much is the bad debt we have? For this illustration, 200 rupees. How much PDD we have? 150 rupees. So shortage is there or not? Shortage is there. If there is any shortage, what do you do? That shortage can be adjusted in the P&L account. Okay, if there is a surplus, then it will be transferable from the PDD to salary. Surplus will be coming in, shortage will be transferred from the P&L account. Here is a shortage, so I am going to debit the P&L account. This is for what? Shortage. This is for shortage. Okay. If we have surplus, what happens then? PDD to P&L account. This will be for surplus if we have. But in this illustration, we don't have the surplus. Now, my question is, how this 150 came? This 150 is nothing but the amount created in the previous year for adjusting this one. This Diwali fund, 24,000 rupees is created by depositing each and every month some amount from the salary to this account, right? Similarly, the last year, the PDD's requirement or the expected debt loss, bad debt loss, to that extent, amount is transferred from the P&L account to PDD account. In the previous year, this might have been passed. Profit and loss account debit to PDD. Okay, PDD 150. Unless you deposit, how will you get? So the opening PDD, this is called opening PDD or balance of PDD available in this year for adjusting the bad debt in this year. In this year, bad debt is 200 rupees. To adjust that bad debt, we have the PDD. Where do we have the PDD? This will not automatically comes, right? It might have been created in the previous year. In the previous year, the entry could have been PDD created, right? So from transferring from P&L account, so P&L account debit to PDD account could have been passed in the previous year. Because of this amount already available, you are using here. See, last year you created is useful in this year. Next year also bad debt will come now. What you can then do? You can create one more PDD for meeting the next year's requirement. Can we do so? Let's see here. I am going to incorporate one new thing. PDD for next year required. Okay, for next year. This is the PDD created in the previous year to adjust the bad debt in this year. Similarly, it happens in the next year also we may face the bad debt. How do I manage that? Create a PDD in this year to meet the bad debt expense. The next year, how much we can create? It's only an estimate. It's not guaranteed number. We estimate almost 200 rupees possible. So we have to create this as a fresh one. PDD supposed to be created in this year end is meant for the next year. So the journal entry here being profit and loss account debit to PDD. This is for what? Next year's requirement. This PDD debit is what? Yes, earlier years amount created is used this year. This is at the time of usage. This is for creation. How much is that? 200. Usually while preparing, we usually club these two journal entries. These two journal entries can be clubbed to pass single entry. Like, okay, if I club these two entry, how about this? PDD debit, PDD credit. So debit side 150, credit side 200. Now it is now PDD only the credit side at rupees 50. We are clubbing these two entry. Profit and loss shortage 50. And here also profit and loss for the next year's created 200. So overall value being 250. So profit and loss account debited with 250. Is that okay? 250. And bad debt in the credit side to bad debt. This value being 200. This is what about the combined entry. You have to be careful if we don't have the provision for doubtful debts, the entry being bad debt account debit to debtors to the next one will be P&L account debit to bad debt. This is the usual one. In the second case, routed through one more provision account. Provision account might have been created in the earlier year to be used in this year. And as we expect the next year also we face some bad debt, we have to create it this year also by transferring to the P&L account to PDD account. So two entries are going to be passed. Okay, while using the previous year PDD for the adjusting the current year's bad debt, it will not be matching. If it is not matching, think whether it's a surplus or shortage. If it is shortage, the shortage is debited to the P&L account. If it is a surplus, credit to the P&L account. Usually what we do know, the usage and next year's requirement, both the entry will be passed together as a combined entry. You have to understand this logic. So for the second category, bad debt with the PDD, you have to pass these two entries. The second entry is the combination of these two entries, right? Come on, make a note of it.